Good morning,
Yamuna,
madam.
Good morning,
Good
madam.
morning.
Yamuna, madam, good morning.
good
Good
morning,
morning.
sir.
Yeah, Mansukh bhai, start.
Yeah. Thank you, my president, CA Vijay Keval Ramaniji, for giving me this opportunity. Very good morning, friends. A warm welcome to this online educational series on IndAS session 4. On behalf of Tax Practitioner Association Thane, Tax Friends Association Mumbai, GST Bar Association Varanasi, Josh Professional Foundation, Association of Tax Professional Vellore, Income Tax Bar Association Prayagraj, Bhiwandi Tax Practitioner Association Bhiwandi, and Legal Relief Society Kolkata. Friends, we are all aware of today's session is on IndAS 12, that is income tax, and IndAS 36, empowerment of assets. Allow me to introduce today's young and very dynamic speaker, CA Shri Chintan Patel. Shri Chintan Patel is a practicing chartered accountant having more than 15 years of post-qualification experience. About his professional qualification, he is a FCA, CPA, CS, FIRS, DISA, and CISA. He is also a regional council member of Western India Regional Council of ICAI and also a past chairman of Ahmedabad branch of Western India Regional Council of ICAI for the year 2017-2018. He has hands-on experience of Ind AS implementation, international financial reporting standards, and generally accepted accounting principle conversion of various listed and MNCs. Chintan Patel is also a regular speaker and trainer at various forums with around 500 presentations at various seminars in India, Dubai, Muscat, Salalah, and many more. Being a respectable member, Chintan Patel has not only professionally but also academically contributed to our society. Some of his major contributions are: he is a co-author of book on quick guide of IndAS and ICDS published by Taxman. His articles are published in ICAI journals and newsletter and many other journals also. He is also an editor of IFRS e-newsletter of IFRS Implementation Committee of ICAI in the year 2014-15. Friends, more interestingly, he is a mentor, editor of Knowledge Update channel on YouTube, and also a contributor to Android application Accounting Auditing Resource. Sir, it is indeed our honor to welcome you with this special and very wonderful, very special seminar. We please welcome Chintan Bhai. Over to you, sir.
Thank you so much, Mansukh bhai. It's really a pleasure to be the part of the associations, and it's really glad to look at the lot of associations come together for the purpose of knowledge sharing. And on Sunday morning, people are able to spend time from 11 morning to 2 p.m. Wow. I think that's what is the most important thing, that on Sunday, at the cost of our family and life, there are a lot of studious and sincere people who wanted to understand and learn Ind AS. So first credit goes to the organization, Vijay Keval Ramani, who is the president of Tax Association Thane, Mansukh Bhai Waghela, who has been taking the coordination of this particular session, and all the participants and members who are spending so much valuable time and coming on Sunday to look at the most important changes and amendments and requirements of Indian accounting standards Ind AS. So the today's session primarily consists of mainly two standards. One is Ind AS 12, that is income tax 6, and second is Ind AS 36, that is on impairment of assets. When I refer to the standards, I would primarily focus on the principles which are the heart of standard. Second thing, I am also going to focus more on the basically the practical issues which can come here and the case studies. As the time permits, we will also look at the disclosures which are already being there for published Ind AS financial statements, so we can connect the standards, connect the training connect the requirements with respect to the published financial statements. Indian accounting standards has been there and implemented for large size companies since so many years, and now it's like more than 3 years since the implementation of Ind AS. But there's need to have learning training for all professionals because this is ever evolving standards. Plus, it is based on international financial reporting standards (IFRS) that also requires you to plan well in advance. Let me just give you a couple of seconds so that I can share my presentation on Ind AS 12. So we can start first with Ind AS 12, and then we'll move to Ind AS 36. Ind AS 12 income taxes is a comparable accounting standard is AS 22. So when we refer to the standard of Ind AS 12 income taxes, we need to also refer to the AS 22. Then we are able to move from accounting standards, which are existing accounting standards, to Indian accounting standards. AS 22 income tax and Ind AS 12 income tax is the word which is used. But practically, this standard is known as deferred tax, because the most important complex thing which has been covered here is the mode of computation of the deferred tax. Current tax is being governed with respect to the provisions of the Income Tax Act. However, when we refer to the accounting standards, when we refer to the preparing financial statements, we need to have the both things together. One is current tax and second is deferred tax. So this standard primarily focus on both income tax, both current tax and deferred tax. However, the majority portion and majority focus has been primarily on the computing, measurement and disclosures of deferred tax. Now, when we refer to these two standards, I think there's a complete shift of the principles from AS to Ind AS when we talk about this standard. Under AS 22, it talks about the principles of income statement liability method. Under Ind AS 12, the principle is on balance sheet method. So there is a change of principle from Ind AS 12 in Ind AS 12 from AS 22. Now, why this change? Because this has been aligned with respect to the best practices in the world, that is IFRS. Now, because of the change of principles from the income statement liability method to balance sheet approach, in certain cases, the deferred tax is required to be recognized, which was earlier not recognized. So understanding the principles will help you to really apply this knowledge in particular aspects, and in certain cases where there may be a difference between AS and Ind AS because of the change in the principles. Now let us look at first the objective of standard Ind AS 12. Any standards, whether Ind AS or AS, they have a set procedure, set format. And in the set format, each standard has been framed. First, for each standard is objective purpose of issuing the standards. In my view, it is the most important for all of us. If you really want to understand standard, first look at the objective. If you are clear with the purpose, the reason why this standard is required, then I think the rest of the things will be more easier for you to understand, grasp for learning the standards. So let us look at the objective. Objective, one line that says it prescribes the accounting for income taxes and also how to account. So it also provides guidelines and prescribes the requirements on how to account for current and future tax consequences for A, the future recovery or settlement of the carrying amount of assets or liabilities that are recognized in an entity's financial statement, that is position. So statement of financial position is balance sheet. So when you look at the part A, it is talking about the future recovery or settlement of carrying amount of assets or liability that are recognized in the statement of financial position. So it is talking about the future recovery or settlement. That is the one important thing which we need to look at in this standard. Second important thing, it says that the transactions and other events of the current period that are recognized in an entity's financial statements. So it focuses on basically the financial statement recording and also the future recovery or settlement of the carrying amount of assets and liability. And these both are required for understanding how to account for current and future tax consequences. So primarily this thing is that it talks about the recovery or settlement. So I'm focusing more on these two words, recovery or settlement. Why? Because when we talk about this standard in detail, at certain places I'm going to focus more on the words recovery, settlement of assets or liabilities. So these four words are very critical for anybody to really understand that what is the reason and logic of recognition of deferred tax in certain situations and which tax rate is to be considered when you talk about the deferred tax recognition. Now let us look at the scope of Ind AS 12. It applies to accounting for income taxes. So basically whatever income taxes has to be done, these all income taxes are being governed under Ind AS 12. Second, income taxes include all domestic and foreign taxes which are based on taxable profits. And third, income taxes also includes withholding taxes which are payable by a subsidiary, associate or joint venture on distribution to the reporting entity. The word withholding taxes has been commonly used across the world, which is mainly nothing but the TDS. So taxes which is being withhold, that is withholding taxes. So in general, when you look at this Ind AS 12, it talks about everything. It talks about everything on taxes, whether it is for current tax, whether it's a future tax, whether it is a and then we need to also look at the future recovery or settlement of assets or liability. So the scope is pretty wide to cover all kind of consequences, and the objective is clear to focus on the assets, liabilities, and future recovery or settlement, and recording and competition of the taxes that may originate on based on that. So I think this particular cartoon which talks about that taxman, there's a taxman and there's a person, and it says that can't you be more efficient? Whatever, how much money you give or how much money you may have, however, is always there is a huge risk which is lying on that whatever money you paid is always short. You're not sure about sometimes the what can come into future tomorrow. Yes, over the period when you look at in since last few years, there has been more stability. But however, the way the taxes are there, the way it has been structured, the stability is difficult to get, and there's always something like that. Whatever money you pay, but yes, it may be a less for taxmen. You have to be ready to get the notices on that. And when you talk about this particular standard, I think why this standard carries the more important, because income taxes has been always one of the most critical thing for any person, whether it's a common man or whether it's a corporates. The income tax is always critical. And as I understand that various tax association has come together, you were dealing with these particular aspects with all your clients, and then for any dealing, any transactions, any future expansion or any planning, the tax is one of the most important aspect which has been always keep in mind. So this standard, and if you look at the history of our taxation structure in India, where we used to have a tax of 98%, and now it is reduced to 30%. Now it's further reduced to 25% and also 15%. So these taxes are always there. And I think there was one statement which was mentioned earlier, that like uncertain life means the tax is something which cannot be ignored by everybody. It's going to be there, and that's why this standard is something which is applicable to all assessees, as the taxes are there for each assessees, current tax and deferred tax. So this is the standard which is applicable to all the clients of Ind AS, irrespective of if it is small, medium or large enterprises. So let us look at this tax expense. As we discuss about objective and scope, the tax expenses are primarily divided into two parts. One is on current tax, and second thing is on deferred tax. So when we refer to this particular standard, we will find the first, there is an emphasis. There has been a discussions on current tax, and there is a lot of discussions on competition of deferred tax. Now, if you refer to this particular part about first on current tax, current tax is based on the Income Tax Act provisions, and the role of accounting in competition of current tax is nothing. As you all are experts on income tax, dealing with the income tax issues, and same way, the accounting standard or Ind AS doesn't talk about the mode of computation of current tax. It primarily says that current tax is governed by the applicable income tax laws to the entity. So as far as current tax is concerned, the standard doesn't provide a guidance on the how to compute current tax, what is allowable, what is not allowable. For that, one need to refer to the Income Tax Act, which is applicable to the particular entity. Now, if the entity is based in India, the Indian tax jurisdiction is applicable. If it is based in some other country like USA or UK or Europe, then the tax jurisdictions of that particular country and applicable to the company will be applicable for determining the current tax. So however, so current tax, when you look at, yes, there is no need to worry on the mode of competition of current tax. Ind AS 12 or AS 22 doesn't provide a much guidance on that. However, it says that you need to follow applicable tax jurisdiction laws and regulations for the purpose of competition of current tax. Next part is on deferred tax. And when you refer to these particular standards, there is a lot of instruction discussions on the deferred tax. Now, there are primarily two approaches. One is on basically income tax. Okay. Right. I think there is one chat in which says that my voice is breaking. I hope that I have received only from one participant. So
yeah, it's all good, sir.
Yeah,
no
okay,
problem.
Thank you. Okay, so income deferred tax approach. There are primarily mainly two approach. One is income statement liability method, and second is a balance sheet liability method. Now, these two approaches are very important for us to understand, because that will help you to really understand the conceptual clarity and principles of moving from the AS 22, which is old or which is applicable to the other entities, to Ind AS. Now, first approach on left hand side, which talks about income statement liability method. Now, this income statement liability method is nothing but it is our profit and loss account approach. So in practical terms, we mean to say that it is a profit and loss account approach, or it is the approach which has been used currently under AS 22 for computation of deferred tax. Now, what is done? Let us look at and understand that the deferred tax principle and how it is computed, this deferred tax under existing scenario as per AS 22. The question which may come here is that whether we required a deferred tax, and it has been the question because the deferred tax is always a very complex. The way of computation of deferred tax is difficult to understand, and sometimes it comes to mind that there is no need to have anything like deferred tax. Wherever something will come, I will do it, and we are, for taxation anyway, we need to refer and look at the Income Tax Act. Then why there is a need to have anything on deferred tax? And that is a valid argument. I'm saying valid argument, not valid reason. So let us look at first conceptual clarity and the reasoning of why there is a need to have deferred tax under accounting standards. If I ask you a question, very simple question, that on the March month, my year end is April to March, and in the March month, the employees have worked and the salary is paid on 7th April. So whether we need to create a provision or liability for the March year end date, I think answer is yes. And I'm sure that 100% the answer here will be yes. Why? Because this is a very common thing, wherein basically we all are aware that if something has been incurred, then irrespective of the amount paid or payable, one need to create a accrual. Based on accrual concept, one need to create a liability. So the concept which has be applicable for that is that salary is to be provided. Why? Because employees have worked for the particular period. The payment is not critical because we follow the principles of accrual basis. Now that is very clear for all of us to understand. That applies to all expenditure, everything in our books of accounts, and that is what is mentioned in our notes on accounts, that is a historical cost accrual based convention. Now again, if I ask you a question or if we discuss about on income tax, certain provisions of income tax says that you would pay tax after 1 year, or certain expenditures are allowable only on payment basis, or depreciation, I will give accelerated depreciation, or I will give depreciation after 4 years, 5 years staggered basis, which is not in line with accounting standards. Now, so that taxation paid in advance or paid later on, that is based on the government policy. And in framing the government policy, there are a lot of things are in mind. It's not only the accounting standard, it is the mode of like giving the benefits or taxing the entity, and collection is a very important thing in the mind of government. The company has worked for year 2019-20. They have earned the profit, the revenue is there. Now because of the government policy or Income Tax Act, certain income which has been earned for the year 19-20, on which the tax has been deferred to the next year or third year, fourth year. Now if I don't accrue tax for the income which is earned during the current year, is this just justifiable? The answer is no. Why? Because the taxes which is paid in the future is not very critical for me. However, if the taxes are related to or pertains to the income which is earned during the period, then the taxation need to be accrued during the period. So taxes primarily consist of two things, as I discussed earlier. One is current tax, second is deferred tax. So current tax and deferred tax, when they both combine together, in that case, it becomes current tax. Now, when we refer to this particular income statement liability method, AS 22, that is on income taxes, which provides a guidance on computation of deferred tax. It mentions the fact that you need to look at the profit and loss statements. So profit and loss statements, income statement liability method, they both are the same thing. In practical way, we say P&L account approach. Why? Because this is what we generally do it. Now, let us look at the approach which is taken for profit and loss account statement approach for computation of deferred tax as per AS 22. Step 1, that what we do, that we start with the profit as per profit and loss account. Then the step 2 is identifications of the income or expenditures which are separately taxable as per the Income Tax Act provisions. So there is addition, there is a deletion. After addition and deletion, and after giving impact as per Income Tax Act, the taxable profit is computed. And this is part of our income statement computation. So when we refer to income tax computation, in that case, we start with the profit as per profit and loss account, then addition, then deletion, and then comes the taxable profit. And on the taxable profit, we apply the applicable tax rates. Now, these adjustment which we do to arrive or to come from the accounting profit to taxable profit, these adjustments or differences are called timing difference. Why timing difference? Because they may or may not be taxable today or tomorrow. So all differences are either a timing difference or permanent difference as far as AS 22 is concerned. I'm putting a base of AS 22 right now because this is something which is critical for us to move from AS 22 to Ind AS 12. So the differences can be either a timing difference or it can be permanent differences. Now, permanent difference is what? For example, some expenditure is not allowable. It may be debited in P&L account, but it's not allowable under Income Tax Act. So it is a permanent difference. If these differences or adjustments are permanent nature, then on that deferred tax is not being created. If these are basically timing differences, then on the timing differences, deferred tax is required to be created. So the process which is being done is that we look at the difference between accounting profit and taxable profit. On between these two dates, whatever differences are there, these differences are divided into two parts. Is it a timing difference or permanent difference? If it's a permanent difference, you ignore it. If it's a timing difference, you do create deferred tax. Now, generally, timing difference which is applicable in all the cases are mainly two. One is depreciation, because depreciation as per books of accounts is different than depreciation which is to be provided as per Income Tax Act. Second thing is the expenditure allowable on payment basis. So in that case, I have debited in my P&L account some expenditure, however it may be paid future. So whenever it is paid at that time in that particular period, that is allowable. So these two are the normally case in majority of the cases where the deferred tax is required to be created. And when the deferred tax is being created, so on that we need to apply the tax rate, that is enacted or substantive enacted tax rate. That is the deferred tax, and it is asset or liability. Now, this is the approach which I talk about is primarily on income statement liability approach or profit and loss approach. Now, two timing difference approach which I discussed. One was on allowable on payment basis. Second is on depreciation. Depreciation is the common for all companies, and the practical approach which is been taken for creating deferred tax on depreciation is that we compare the WDV as per tax block with net block or carrying amount as per books of accounts. And on that particular base difference is the deferred tax asset or liability amount closing balance is computed. And from that closing balance, the opening balance is minus, and then the differential is my deferred tax income or expenses. So just to repeat this again, because this has been followed in many cases, that practically, even if, so if you look at technically, when you apply the income statement liability approach, it says that you need to basically look at depreciation which is added and reduced on that, plus you need to consider any disposals, any sale, and then you need to arrive at the deferred impact. Now that is very complex, where it is not only depreciation. Along with that depreciation, you may to consider a lot of things, because under Income Tax Act, if the asset is sold, it will be 100% amount is being reduced from the block, which is not the case for the purpose of accounting profit depreciation. So the approach which has been done is that where we look at the carrying amount in the books of accounts, that is net WDV, net block in the books of accounts, that net block is compared with WDV as per Income Tax Act. And difference between these two is my deferred tax asset or liability, and that is my closing balance. And from closing balance, opening balance is being reduced, and then to arrive at the deferred tax income or expenditure or reversal thereof during the period. So this is basically approach which is done even under accounting standard for practical point of view. So what we are doing it in, that is called the balance sheet approach. So even if the income statement liability method is with there, however, the approach which is being done for the purpose of computation of deferred tax in case of depreciation is nothing but the balance sheet approach. So that second approach which is there for deferred tax is called the balance sheet approach, balance sheet liability method that focuses on temporary differences. So there are two methods. One is a timing difference, and second is a temporary difference. Timing difference is primarily basically on income statement liability method. We'll take questions little later on, so that I think we can have a flow of conversation, and then we can take up the questions. Santoshi. Yeah. So income statement liability method, and then second is balance sheet focus. Under income statement approach, it is called timing difference. Under balance sheet approach, it is called a temporary difference. And then on these differences, deferred tax is created. Now, when we talk about Ind AS 12, we are focusing on the balance sheet liability method, that is temporary differences. Now, so we are moving from the objectives, scope, principles, and then to the AS 22, then from to Ind AS 12, and this is where we need to land to understand the temporary differences, which is the acceptable principles for computation of deferred tax under Ind AS 12. Temporary difference is nothing but it's a difference between the carrying amount of an asset or liability and its tax base. So what it says that you need to compare the two things. One thing, you need to look at the carrying amount of assets or liability, and then you need to look at the tax base. Now, what is tax base? I think that is the first question which come into mind, is that what is tax base? Tax base is basically the balances as per Income Tax Act, that is called tax base. So difference between the tax base and carrying amount, this is called temporary differences. Now, is this something new? Is it something different? Technically, yes. But practically, as I discussed about depreciation, you would have done the same thing. We have compared the carrying amount, that is the net block of assets, property, plant, equipment, with the tax block or WDV as per Income Tax Act, that is called tax base. And on that difference, that is called temporary difference, on that difference, the deferred tax assets or liability is computed. So the temporary difference is nothing but tax base of an assets or liability, the amount attributable to that assets or liability for tax purposes. So one more question will come to mind, that are we preparing the balance sheet as per Income Tax Act? The answer is no. We don't prepare a balance sheet as per Income Tax Act. So if I don't have balance sheet as per Income Tax Act, then in that case, how can I know the tax base? And how can the tax base be being compared or reconciled with respect to my carrying amount? So in that case, there are certain formulas, certain principles which are provided under Ind AS 12, which talks about the computation of tax base. Now, last point is that if there are no tax consequences of recovery or settlement of assets or liability, then tax base is equal to carrying amount, and there is no temporary differences. See, I think if you look at the understanding this from concept point of view, what is happening is that we have a concept called permanent difference under AS 22, and there is also concept of Ind AS 12 where we need to compute basically temporary difference. Now there is no concept or there is no word permanent difference which is used under Ind AS 12. However, there is no need to create a default tax where there is no temporary difference. So where there are no tax consequences of recovery or settlement of assets or liability, then the tax base is equal to carrying amount. Because if there is no tax consequences, obviously there is no point of creating a temporary difference and default tax on that. So if there are no tax consequences, in such case, you need to have a tax base that is equivalent to the carrying amount, and then there is no temporary differences. Now coming to the point which I talk about, that under Income Tax Act, there is no balance sheet is prepared. So how to have a tax base and the carrying amount? So for that, the principles has been provided of computation of tax base under Ind AS 12. Before that, let us look at the types of temporary differences. Temporary differences are divided into two parts. One is called a taxable temporary difference, and second is called deductible temporary differences. Taxable temporary differences, as the name itself suggests, taxable is nothing but the deferred tax liability. And when you talk about the deductible temporary differences, the deductible temporary differences is called deferred tax assets. So temporary differences which are deductible in the future, right? So what is happening? The temporary difference, there is a difference between the tax base and carrying amount, and that difference, whether that difference will be helpful to be me in the future to pay less tax or more tax. If I have to pay less tax, that means it is the deductible temporary differences, then today it's asset for me because I have to pay less tax in the future. So if it is a deductible temporary differences, then it will rise to a deferred tax assets. If the temporary difference is taxable, that means what? That I may have to pay the higher tax, or I have to pay tax during the future period. Then it is called liability, because it is liability is created because of the today, which is going to be paid in future. So it is called deductible temporary differences. It is called taxable temporary differences. So if the taxable temporary differences liability is created, it's called DTL. It is a deductible temporary differences where the asset is created where we don't pay less tax in the future. It is called deferred tax assets. Now let us look at this tax base of assets. How to calculate the tax base of assets? Tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the assets. So what it says that if it is you're talking about assets, and what is the tax base of assets, it's the amount that will be tax deductible. So in future, whatever amount you can get as deduction. So when I talk about the income WDV of for depreciation point of view fixed assets, so the WDV is nothing but the amount that is deductible to me in the future. So that deductible amount is my tax base of that particular assets. Carrying amount is nothing but the net block in my books of accounts. So tax base is the amount of that will be deductible for tax purposes. Now let us look at the first case of inventory. The amount of inventory in the books of account is 100 rupees. Tax details are it is deductible for tax purpose when it's sold. So the amount of 100 rupees in my books of account, it is deductible to me in the future. So my tax base is how much? 100. Interest receivables, 100 is carrying amount, and tax detail says interest will be taxed on cash basis. So if it is to be taxed on cash basis, means it is receivable, so it is deductible. Answer is no. Deductible is only when it is going to reduce my tax. Here is not deductible. So what is happened that in the interest receivable, the entry was passed as interest receivable account debit credit to interest account. So in my profit and loss account, income was there, in balance sheet interest receivable was over there. Now this says that it is to be taxable when the cash is received, or when it is cash is received. So that's why my deductible is 0. So it will create a temporary difference. For that, one need to create a deferred tax. Third is revalued loan, revalued land. So land is revalued. Now the amount is 140. Taxation point of view, the indexation is available. Now we discussed that whether the amount will be primarily recovered through use or through the sale. It is primarily be recovered through sale, and in that case I am going to get the indexation of that land. So for the purpose of tax base of land is 110, because 110 is amount which is being increased from indexation 100 to 110, because this is going to be recovered by way of this sale, and indexation is available. Let us look at one very simple case study, but however, it is more relevant, more important, because the depreciation is something which has been generally being there for all the companies. So an entity acquired a plant and equipment for rupees 10 lakhs on April 1, 2019. The asset is depreciated at 25% a year on straight line basis, and local tax legislation permits the management to depreciate the asset at 30% a year for tax purposes. Calculate any deferred tax liability that might arise on the plant and equipment at March 31st, 2020, assuming tax rate of 30%. I think this is basically where my depreciation rate is different. under taxation and also in my books of accounts. So 25% is being depreciated on straight line basis, and under Income Tax Act it is at 30%. So there is 5% gap. So that 5% first year will arise into the amount of 10 lakh into 5%. That is my temporary difference. And on that temporary difference, I need to compute tax rate. Tax rate that is at 30%. So basically, I think there are few Okay, right, very good. So I think Mr. Kedar Nath and Yogesh has basically written the things. Yes, the tax is basically 15,000. Reason is that 30% of temporary difference of 50,000 rupees, and that is what is to be created as far as this deferred tax is concerned. Now let us look at the tax base of liability. Tax base of liability it's a carrying amount less any amount that will be deductible. Tax base liability is a carrying amount. Just a minute, let me just right. So it is a tax base of liability is a carrying amount less any amount that will be deductible for tax purposes in respect of that liability in future period. My carrying amount of the loan payable is 100 rupees. Tax details. It says repayment of loan will have no tax consequences. So when you refer to this, it says liability less any amount that will be deductible for tax purpose. So is it amount deductible? Answer is 0. So 100 minus 0 is how much? 100. So amount deductible is 0, but the formula says that carrying amount less amount deductible. Amount deductible is 0, carrying amount 100, 100 minus 0, tax base 100. Accrued which is 100. The tax is said that which is allowed as tax reduction at the time of expense recognition. So here what happens that I have recognized I have recognized this, the amount which is deductible for tax purpose is how much? 0. 100 minus 0 is 100. Let us look at sales tax payable 100. Allowed as a tax reduction under section 43 on actual payment. So amount is not paid. It is going to be paid in the future. When it is paid, Income Tax Act says that you can get deduction. So how much amount that will be deductible for tax purpose in the future? 100. What is carrying amount? 100. So what is tax base? 100 carrying amount less amount of deductible as a tax is at 100. That is 0. So this is the way the tax base of liability is computed. Yeah. So Minlali, basically loan payable is 100. My tax details says repayment of loan will have no tax consequences. The formula says tax base of liability is a carrying amount less amount deductible. Now amount is not going to be deductible for loan payable. So amount not is deductible is how much? 0. So carrying amount is how much? 100. 100 minus 0, that 100 is my tax base. So when tax base is 100, carrying amount is 100, temporary difference 0, no deferred tax. Next is tax base of revenue received in advance. I think I will take Santosh ji, आपका question मैं ले लेता हूँ, but then we'll take all question later on, because otherwise what happened that others will also be. I think okay, if the sales tax paid is only, then so I think your question is that if the sales tax paid is only, then deferred tax will come only 50. Okay, if the sales tax paid is only 50. See, basically, if sales tax is already paid, then payable will be 50. And in the future, you are going to pay 50. and on that 50 you're going to get tax reductions. If answer is yes, then you will create deferred tax on 50, not 100, because 50 is already paid. Tax base of revenue received in advance. Tax base of revenue received in advance is carrying amount less any amount of revenue that will not be taxable in future period. So what is happening here? The revenue received in advance is 100. That is carrying amount less any amount of revenue that will not be taxable. So if it is not to be taxable in the future, that is what you reduce from carrying amount to arrive at the tax base. Let us look at tax base. Rental income taxable in the future when accommodation provided. So it is going to be taxable in the future. So amount not taxable is how much? 0. So 100 minus 0, 100 is my tax base. So that means there is no temporary difference. Royalties 100. Tax details, it is taxed on cash basis, deferred in balance sheet until the period to which it relates. So basically what is happening here is that again it is nil. Why? Because tax on cash receipt basis. Exactly. So that is a nil, as Yogesh and Mrinal is talking about. So because the not taxable in future 100, 100 minus 100, 0. So carrying amount 100, tax base 0. That will be create temporary difference of 100 on which deferred tax is to be created. Now let us look at the summary of temporary differences. Basically, if the carrying amount is more than tax base, so carrying amount, let us take assume the example, carrying amount is 100, tax base 80. So carrying amount is higher, tax base is lower. 20 is a temporary differences. So what happened that, let us look at assets. When for assets, 20 is temporary difference means I am going to get lower tax deduction in tax book. So that is what it's called taxable temporary differences. So it is a DTL. If my liability, it is for liability, is lower in taxation, so what will happen? My deductible temporary difference, and then it is a deferred tax assets. So once you know one part, rest are just reverse. So if it is assets, then liability, then reverse. If it is a carrying assets, is carrying amount is lower than tax base. If it is assets, then it's a deductible temporary difference DTA, and then reverse DTL. Both are equal. There is no temporary differences. There is no DTL. Now this is just understanding conceptual point of view. In what cases DTA and DTL can originate, because we may understand it is a temporary difference. However, the temporary difference, whether it arises to DTA or DTL, for that you can refer to this particular chart to understand whether my tax base is lower or higher than carrying amount, and then whether that is for assets or liability. That will give idea on a summary of temporary differences. Now, this is a chart basically to understand about the temporary differences that arising on initial recognition of asset liability. Now, as I discussed earlier that what happened that under AS 22, there was a concept of permanent differences. Under Ind AS, there is no permanent difference concept is recognized. However, they identify certain situations where it's possible that it is kind of permanent differences where there is no need to create a deferred tax. So for that, there's a small chart which looks complex. However, from practical point of view, it is not so much difficult to understand on which there is no deferred tax to be created. So does the temporary difference arise on initial recognition of asset or liability? If the answer is no, then recognize deferred tax liability or asset subject to other exceptions. So if there's no temporary differences, then on initial, then there is no point of that. If it arises on temporary difference on initial recognition of as a liability, then is it arise because of business combination? If yes, then recognize DTA. If no, then does the transactions giving rise to the asset or liability that affects either accounting profit or taxable profit at the time of transactions? If answer is yes, it affects, then yes, you would recognize a temporary deferred tax. If the answer is no, it doesn't affect accounting profit or taxable profit, then there is no need to create a deferred tax except in case of business combination. Let us look at one example on that. Basically, a non-taxable government grant 200 related to the harvester asset 600 was given to a farm limited. For tax purpose, the grant is not taxable and tax rate is 35%. See, when the grant is not taxable, that means it may be kind of the permanent difference which is being originated. So in that case, there is no need to create a deferred tax on this, as it is not going to arise any kind of differences in the future. So there is no need to create deferred tax, as it also not arising from the business combination. One important thing which we would like to discuss on financial instruments. As I understand that there is a separate session on financial instruments, and I think it is yet due. But so I'm not going to focus more on the principles and the accounting of financial instruments. However, the objective is to really talk about the tax implications on which may arise on one very particular feature of financial instruments, that is compound financial instrument. Compound financial instrument is an instrument where there are both components are together. That is liability and equity. If you look at the balance sheet, in the balance sheet there are mainly three components. One is assets, second is liability, third is equity. Liability and equity, there are two different components. Now, this is a kind of instruments where it is a compound where it includes both components. Compound by meaning itself means it's combination of two elements, which is a liability and equity. Now, what happens that under Ind AS 109 financial instruments, this compound financial instruments is required to be classified into two parts based on fair valuation of liability and equity. Now, for example, there are basically convertible debentures, which is being divided into two parts. 100 rupees is converted debentures, and that 100 rupees converted debenture is divided into fair value of liability and equity. Fair value of liability is 70, equity is 30. So 30 is moved from liability to equity. Now, this particular point arises the question of deferred tax. In that case, what will happen that in Income Tax Act books, that debenture is still liability. That liability is not reduced under Income Tax Act, and it doesn't become 70 in the books of taxation. So there is a temporary difference between these two components. In that case, the standard says that you need to create a temporary difference and deferred tax on the difference, and that deferred tax will be offset against the equity of 30, which has been taken to the changes in equity statement. So in some jurisdiction where the tax base of liability component on initial recognition is equal to initial carrying amount of the sum of liability and equity components, the resulting taxable temporary differences arise from the initial recognition of the equity component separately from the liability component, and not the initial recognition of assets or liability. As there is a component which is moved from the liability to the equity, it arises from the initial recognition of the equity component. Therefore, the exemptions does not apply, and one need to create deferred tax on that particular part, which is moving from liability to equity. Next very important point is on goodwill. Goodwill, if it arises from initial recognition, see, if you look at that particular table or chart which I discussed, it mentioned that if it arises from initial recognition of goodwill, then only exception is business combinations. So if it is a business combination, then you need to create a deferred tax. Now, if the goodwill has arisen due to business combination, and the goodwill is a residual figure, if you look at Ind AS 103 business combination, it mentioned the fact that the mode of computation or purchase price allocation is that we need to arrive the fair value of the assets liability, and from the consideration, the fair value of asset liability is reduced and the residual amount is goodwill. Deferred tax is required to be created on the difference between the fair value of asset liability and the carrying amount of the acquiring company. What is the tax base of acquiring company? On that difference is basically deferred tax is to be created, and that will be adjusted at the time of doing the purchase price allocation. Residual amount which is arising in goodwill. So question is that goodwill is arising in my books of accounts. Well, there is no goodwill as far as Income Tax Act is concerned, because that goodwill is not allowable as a amortization charge in my Income Tax Act. So whether we need to create a deferred tax on these things, the answer is no, because goodwill is a residual figure. If you create deferred tax on that, it will just be multiplied onto goodwill only. So it is not to be recognized. However, if it does not, if it does not arise from initial recognition, so deferred tax liability for taxable temporary differences, if they relate to goodwill, are recognized to the extent that they do not arises from initial recognition, that is, tax laws allows write-off. So now if tax jurisdiction allows me that goodwill can be amortized, then obviously I will create deferred tax on that, because that it is allowable in my tax jurisdictions. However, in carrying amount, it is tested for impairment in my books of accounts. So in that case, there will be a temporary difference and it is to be created. Let us look at the business combination. I had touched upon the very important principles in the earlier slide on business combination. However, as we discussed in detail about this previous slide, acquisition accounting is required to be applied for the purpose of Ind AS 103 business combination. So one need to allocate the cost of business combination to the identifiable assets and liabilities acquired by a reference to their fair value at the date of exchange transactions. So you would allocate the cost of business combination, as we discussed, that purchase considerations need to be allocated to the identifiable asset liability as 103. Then there will be temporary difference which that will originate, because the tax base of identifiable asset liabilities are different than the fair value of that asset liability. Let us take one small example to understand this situation. B Inc. acquires AS Limited. The cost of the plant of AS Limited is 800. Its fair value is 1000. B Inc. recognizes the assets at fair value. Tax base is 800. Now, what is happening here is that as I acquire a company, the company already prepares the tax returns. The company has already done all tax compliances. Now, the 800 rupees is the value. However, for the purpose of 103 business combination, I take it as 1000 rupees. So 800 rupees is increased to 1000 rupees by 200 rupees. Now there is a difference between 1000 and 800, because when the particular company files its income tax return, it is not going to say it is 1000, it's 800 rupees only, because under Income Tax Act, the block of that particular subsidiary company is not being changed. So that 800 rupees remains as income tax return for that particular subsidiary company. For the purpose of my accounts for consolidation, when I look at fair value, that is 1000 rupees. So there is a 200 rupees is difference between my carrying amount in my books of accounts and the tax return as per the particular company. On the temporary difference, what do to create a deferred tax? And it is at the time of the acquisition. So it will result into the goodwill change, because as I create a deferred tax on that particular temporary differences which originate on that particular assets, it will result into the goodwill, because goodwill is nothing but the residual figure. So the entry will be goodwill account debit, credit to deferred tax liability. Next point, which is very important, is on investment in subsidiaries, associates, joint ventures. So this particular point which come into picture is basically when I have investment in the entities which are my subsidiary, associate, joint ventures. As far as my separate financial statement is concerned, in my separate financial statements, it is investment. When I prepare my consolidated financial statements, what is happening that if it is a subsidiary, then we need to do line by line consolidation by applying Ind AS 110. You apply line by line consolidation by applying Ind AS 110, then the investment will be eliminated and all assets, liabilities will be recognized, and the profit or loss of my share is also recognized, because in my equity there will be two separate components. One is the equity and another is minority interest. So what is happening that the all profit or loss of that subsidiary company is also being recognized in my books of accounts. Now when we refer to the associates and joint ventures, we apply equity method of accounting for investment in associate joint venture. Under equity method of accounting, what is done that sharing profit or loss of associates and joint venture, sharing profit or loss of associate joint ventures is recognized when we do consolidation. So the entry which is passed is investment account debit, credit to sharing profit of associates on profit and loss or income statement comparison or statement of comprehensive income. There's separate line item that says share of profit from associates. Now that is being recognized in my books of accounts. Now these sharing profit of associates, if I have received in my during the year as a dividend, then I will show as my income and current tax is recognized. However, these profit which on which share I recognize, on which a dividend is not declared, however, the profit sharing profit is recognized today, the dividend may be declared in the future. So whether dividend may be declared in the future, I may be required to pay tax on that. So income is recognized today, the tax is not being recognized. So I need to create a deferred tax on that particular component, because whenever the dividend is received, I may have to pay the tax. So by just postponing the dividend recognition, postponing the income recognition, I cannot basically postpone the taxation. So once I recognize sharing profit of associates, the taxation which may be payable in the future, it also need to be recognized in the current year's consolidated financial statements. However, there is basically exemption that you may not be required to recognize the deferred tax liability for all taxable temporary differences if the following both conditions are fulfilled. One, the parent, investor or venturer is able to control the timing of reversal of temporary difference. And two, it is probable that the temporary difference will not reverse in the foreseeable future. So these both conditions are required to be fulfilled for not creation of deferred tax liability. One is that the parent or investors control the timing of reversal, and two, that is probable that the temporary difference will not reverse in foreseeable future. So basically, I have investment in associated joint ventures where I'm sure that looking at the condition of these particular joint ventures, it may not be able to declare a dividend, and there may not be any taxability which may be arising in the foreseeable future. So if that is the situations, I should not create the deferred tax on that. Other than that, for all these temporary differences, deferred tax is required to be created. Let us look at one case study to understand. On 1st January 19, entity A acquired 100% shares of entity B at cost of rupees 600,000. At the acquisition date, the tax base in entity A's tax jurisdiction of A's investment in entity B is 600,000. During the year ended 31st December 19, entity B made a profit of 150,000 and declared a dividend of rupees 80,000, recognized as liability by B on 31st December 2018, determined the deferred tax implications of A Limited in consolidated financial statements. Now, what is happening here is that 100% shares is acquired. 600,000 is basically a investment in entities A. Profit of 150,000 rupees is being recognized. 80,000 rupees is dividend. So 150,000 minus 80,000, it means 70,000 rupees is not being declared. So if I received a dividend, I have paid tax. Profit is earned today, but I have my tax is deferred for 70,000 rupees. Why? Because the dividend is not declared. So even though profit is earned, I have recognized profit and consider profit in my books of accounts. So I also have to create a deferred tax on 70,000 rupees because that is a profit which is earned during the period, even if the tax implication has been deferred in the future. Yes, Ketan, I think that is tax on 70,000 rupees. Preeti, I think I have also discussed this along with my case study, so I hope now it's clear. And Ketan, with respect to your question, future dividend, I think now the point is clear. So if something is remaining, then please let me know, or we can take in the last point during question answer session. Recognition of deferred tax assets. Principal, recognized DTA. Preeti, you want to explain again? Okay, let me just run through this slide. I already explained 2 times, but one by way of my principal, second by way of case study. We'll again take into question answer your particular query, and I will again explain you that at that time. Let us look at the first recognition of DTA. Recognize DTA only when it is probable that taxable profits will be available against which deductible temporal differences can be utilized. So now why there's a need to have principles of recognition of DTA? Wherever we create any assets, we need to be very cautious about the creation of assets, as principle of conservatism come into picture. So if I create some asset, means I assume that the amount is recoverable in the future. So the principle says that you should recognize deferred assets only when it is probable that the taxable profit will be available against which the deductible temporary differences can be utilized. Let us look at the 3 situations here. First, if there is sufficient taxable temporary differences available. See, one point which we need to understand is that the recognition of DTA is based on its availability when it is recovered or settled. At that time, there has to be sufficient taxable or sufficient deductible profit should be available against which it is set off. So DTA can be recognized to the extent there is a possibility of getting deduction. Now, deduction can be taken when I have profit in the future, or I have some deductible temporary differences that also reverse in the future, against which my taxable temporary differences can be offset. So the first point which says that sufficient taxable temporary difference available. So I have a deferred tax liability, and that deferred tax liability is going to be reversed in the future, and there will be deferred tax asset which is going to be reversed in the future. They both can be offset against each other. So in that case, I am safe that my DTA will be recovered to the extent of DTL. If there is sufficient taxable temporary difference is not available, then you need to consider that do you have sufficient future taxable profit? Because if you have a DTL is there and DTL is received reverse, DTA is reverse, the both DTL and DTA both are reverse and both are offset each other, then there is no point. But when there's a DTL is not sufficient, like I have a DTA of 100, DTL 20, so 20 reverse, DTA 100 reverse, I understand 20 will be offset, 80 will be remaining. So I don't have sufficient taxable temporary difference, so I need to look at my sufficient future taxable profit, because this DTA is a tax deductible. So in the future, I should have a sufficient future taxable profit is required. And whether there is tax planning opportunities available. So if that is available and if it's probable that the taxable profit will be available against which the deductible temporary difference can be utilized, no issue, no problem, create deferred tax assets. However, as we are aware that if there's unused tax losses and unused tax credits, in that case, one has to be more cautious. Why does it be cautious? Because unused tax losses means company has a huge brought forward carry forward losses, and if that is there, then the probability is such that I may not be able to have a sufficient taxable temporary difference. If it is available, then it's no issue. But if there's no sufficient taxable temporary difference which are available to offset my future deductible temporary differences, in that case, the future taxable profit is doubtful. So principle is same, that you recognize to the extent of taxable temporary differences. However, you need to have a convincing evidence to support for recognition of DTA in case you have unused tax losses and unused tax credit. The existence of unused losses is a strong evidence that profit might not be available. See, if you look at the principle is that I can recognize asset only when the future I can get the benefit. If in the future there is no point of getting benefit, I should not recognize asset. So benefit can be received by way of the reverse of deferred tax liability or by way of taxable profit. So if you have the huge losses, in that case, probability may be lesser. However, the 4 criteria to be considered before DTA can be recognized in these cases. 1, whether the company has enough taxable temporary differences that relating to the same tax authorities and the same taxable entity to create taxable amount against which the losses or credits can be used before they expire. 2, whether it is otherwise probable that the entity will have a taxable profit. I think these 2 things we discussed earlier, same things are there. 3rd, whether unused tax losses result from identifiable causes that are unlikely to occur. And last, are tax planning opportunities available to allow taxable profits to be created in the period in which the losses or credits can be used. I think these 4 things additionals to be considered because you have the history of the past losses, and when only your probable or certainty is there, then the DTA should be recognized. Now, the standard says that you need to review DTA and DTL because DTA is creation of DTA is not a one-off exercise. You also have to do review, annual review, because whether my DTA amount which is I've created is sufficient, is appropriate, whether the probability criteria is still there or not. If there's a change in taxation, if there's a change in the probability, then my DTA, DTL should be modified accordingly. So DTA, DTL creation is not one-off exercise. Point number 1. Point number 2 is that the recoverability of the deferred tax asset or is reviewed at each balance sheet date. 3rd, the carrying amount should be reduced to the extent that it is no longer probable that enough taxable profit will be available to allow the asset to be recovered. And fourth, any such reduction should be reversed to the extent that it once again becomes probable that enough taxable profit will exist. So basically, you need to see that at every reporting date, the amount of asset and liability should be such that it is a probable of recovery and it is to be payable. That exercise to be done and then it is to be adjusted. Recognizing tax income and expenses. The rule says that one very critical thing that where to recognize income tax or expenditure, it is part of my profit and loss. Simple. In my statement of comprehensive income, one need to recognize the tax income and expenses. However, there are few exceptions to this rule of recognition of these in the income statement. The exception says that wherever the component for which the tax is being recognized, that component is not in other statement like other comprehensive income or in equity, then the tax will be recognized with that component. Second is a exceptional business combination. As we discussed that in case of business combination, so if the deferred tax is created at the time of acquisition, it will result into the goodwill. So except these two things, in all cases, the tax income or expenses shall be recognized in my profit and loss part A. However, if the component in part B, other comprehensive income, so that tax of that particular component will be recognized in the OCI. If that component is in equity, as we discuss on the compound financial instruments, then that is to be taken to equity. So these are the few things. The exceptions are recognition in OCI. As I given an example earlier that in case of revolution reserve. So one of the most important thing which I also discussed is that under Ind AS 16, there are two models. One is cost model and second is a reversion model. So in case of reversion model, there is an increase in reversions, then it will go to OCI. So if the deferred tax is created on that, because what is happening that my tax base is 100, carrying amount is increased from 100 to 120, 20 is reversion surplus, 20 is taken to my OCI as reversion surplus. Now my tax base is 100, carrying amount is 120, temporary difference is 20. On that temporary difference or 20, the deferred tax is to be recognized, and that deferred tax is related to component of which component? Reversion reserve. And the reversion reserve goes where? In comprehensive income part A? No. In part B, other comprehensive income. So that is the reason why when we look at in other comprehensive income, it is net of taxes. So that deferred tax on all the components which are there in OCI, these are considered because of the concepts of balance sheet approach. So in OCI, the reversion reserve, foreign currency transition reserve, again, deferred tax will come into picture. Equity recognition, Ind AS 8, change in accounting policy correction of errors, compound financial instrument, as we take an example, that again on that also there will be a deferred tax on that, and business combination, as we discussed earlier, that will result into the deferred tax which will be adjusted to goodwill. Measurement of deferred tax asset and deferred liability. There is some issue on the line, but I will discuss on that. So principle says that you need to measure deferred tax based on the tax rate when the asset is realized or liability is expected to be settled. So today something is there. So in which year this is going to be realized or settled? In that year, whatever tax obligation is that tax rate I have to use for the purpose of measurement of my temporary differences. So the tax rate is enacted tax rate or substantively enacted tax rate. Substantively enacted tax rate is the tax rate which is announced in budget and which may be requiring only precedent assent. It is called substantively enacted tax rate. So logic is such that whenever the temporary difference is going to be settled or recover, at that time the tax impact will come picture. So whatever the tax impact at that time, that tax rate one is to consider for the purpose of measurement of deferred asset or deferred liability. If tax slabs at average tax rates, so basically if there are tax slabs for individuals, we have a tax slabs are there. But however, in case of business companies, and there is not a tax slab, there is basically one tax rate.
चिंतन भाई आवाज नहीं आ रहा है. I think net connection is been disconnected. Kindly hold on, he will join in back. Just hold on, please. There may be some net issue.
अनम्यूट करिए चिंतन भाई.
आपको अनम्यूट करना पड़ेगा उनको.
यस.
हाँ.
Yes.
Yeah, continue.
Yes, okay, fine. Maybe there is some technical issue, so let me share my presentation first. Right, so you need to look at the tax rate, which is enacted or substantively enacted tax rate, and that you expect to apply when the assets is when the temporal difference is reversed in the future. So here I think we discussed that if the tax slab is at average tax rate, which is generally in case of individuals where there are tax slabs are there, so in that case you can take average tax rate. However, in case of the business people, generally it is not a tax slab, so then you can take the applicable tax rate here. Expected manner of recovery and settlement of carrying amount of its asset liability. So you need to look at also the what is the expected manner. So which tax rate is to use? If there are two separate tax rates in case of the sale of asset and use of assets, then I need to consider my expected manner of tax which I may be required to pay, and that tax rate I have to use for the purpose of my measurement of tax. If recovery through sale, then I need to use the tax rate which is applicable for sale. If it is recovery through use, then I have to apply the tax rate which is applicable in case of use. If there's a revolution, and then I may have to look at the tax rate which is. So ultimately, if you look at the overall understanding, it says that whenever the temporary difference is created, you need to look at in which year and how the tax will be paid or settled in the future. And whatever tax will be applicable at that time, that tax rate you have to consider for the purpose of measurement of your deferred tax asset liability. And one more thing, it is not to be discounted because this is not to be done at present value, even if it may originate, it may reverse after 2 years, 3 years, 5 years, but it is not to be discounted, specifically mentioned under standard. Presentation of deferred tax asset or liability in balance sheet, set off of DTA and DTL. So it says that when you have a legal right to offset, and if you intend to offset, then your current tax asset and current tax liability can be offset. For example, a company has one tax jurisdictions and assets and liability both can be offset, which happens in general in case of the standalone company. If it's an Indian company, there is a tax which arises from Indian standalone company and tax which is paid for another company, they both can be set off. So the current tax asset, current tax liability can be offset because of I have to file only one ITR and then I can do it. In case of my consolidated financial statements where I have a separate tax deductions of subsidiary associate joint ventures, in that case, deferred tax assets of my holding company and deferred tax liability of subsidiary company cannot be offset. But they both are in the different tax jurisdictions. So offset of DTA and DTL has two conditions. One, there's a legal right to offset, and second is entity intent to offset. When these both conditions fulfilled, in that case, yes, it can be offset. Otherwise, you have to show both separately. The approach for determining income tax, I think current tax, we discussed that it's basically based on your applicable income tax jurisdictions. What are the provisions are mentioned in that particular thing, that you have to do it. As far as deferred tax is concerned, as we are covering the short summary of what we discussed, as far as deferred is concerned, there's tax base, carrying amount, compared carrying amount with tax base. Difference is called temporal difference. The temporal difference can be DTA, it can be DTL. When you do tax rates, so you have to look at enacted or substantive enacted tax rate for measurement of temporal differences and create DTA to the extent it is probable. There are principles of offsetting that also you have to consider when you want to offset DTA with the DTL. Now let us look at the major difference between AS and IndAS. The basis is different, as I told you earlier, that under Indian GAAP it is called income statement approach. Under IndAS it is called balance sheet approach, where temporal difference come to picture. Deferred tax on revaluation of assets. Under AS, as it is income statement approach, if there's a revaluation, there is no deferred tax is created because under income statement approach there is no impact on my profit. So accounting profit and tax profit both remain same. As far as IndAS is concerned, we compare the carrying amount with the tax base. Carrying amount is increased, tax base is not, which is going to also change in the future. Hence, we need to create deferred tax also on revaluation surplus. That is difference. Deferred tax on business combination and Indian GAAP, it does not create any, because under Indian GAAP again principle is of the profit loss approach. The assets and liabilities fair value is increased, but there is no impact on the profit and loss account. Under IndAS, the carrying amount tax base is different, so we need to create deferred tax on that. Recognition criteria of deferred tax assets. Under Indian GAAP, it says that if you have carried forward losses, then virtual certainty is required. Under IndAS, it says that you need to have a convincing evidence if you are having unused tax loss and tax credits for the purpose of creation of DTA. I think with this, our income tax IndAS 12 standard is completed. Now we can look at your questions.
Thank you.
Okay, I think.
Thank you, Chintan bhai.
Bagela ji, tamare
Yes, sir.
share karo upar se questions, because my questions.
Yes, sir. So I will read out, karo chu. I will read out, sir.
Yeah.
There are some questions. Can we take some questions, sir?
Yes, please. We should.
Yeah. Question number 1 is, earlier it was income and liability method in accounting standard 22 and now it is a balance sheet approach in Ind AS 12, whether the value of current tax and deferred tax will remain same in both the cases?
See, current tax remains same, because if you look at the AS 22 and IndAS 12, current tax is both says that it is based on my tax jurisdiction. When we talk about the income statement approach and balance sheet approach, they approaches are for deferred tax, not for current tax. So current tax will remain same.
Thank you. I think it's clear. So second question is, losses of previous year as well as current year is also considered for deferred tax?
Losses of previous year, yes. See, basically, whenever the loss is created, at that time you will definitely create deferred tax. And as far as the balance sheet approach is concerned, we look at what? We look at the accumulated cumulative losses, and then on cumulative losses we create a deferred tax. And then in opening, if the deferred tax is not created, the impact will come in. If in the opening deferred tax is created, then basically only the basic differential amount will come into the current year. So you need to create cumulative impact, because it's a balance sheet approach. In the balance sheet approach, we need to look at the closing balance. On closing balance, we need to create deferred tax, and then from that we need to reduce the opening, and then the resulting is my charge in my P&L account, or charge in the OCI, or charge in the current year.
Thank you, sir. Third question is, how to account for a change in income tax rate, whether it should be applicable on old or on opening balance?
Right. So that's a very good question. Basically, as I discussed, that we need to apply enacted or substantive enacted tax rate. Now, what happens that last year again, Income Tax Act has come into picture, wherein they give the option where I can go for the reduced tax rate with not taking some allowances, and that was not there in the opening. So in the closing, it was there. So here the approach is a balance sheet approach. The same response which I give for carried forward losses. What we have to do here, we have to create the temporary differences as on the reporting date. On the reporting date, all temporary differences, you have to apply the enacted or substantive enacted tax rate as on the reporting date, and then you reduce opening. So all opening are also being changed with respect to this differential impact. So your opening tax rate was at 35%, closing tax rate at 30%. So the impact of all opening temporary differences which are still outstanding are also given in the current period.
Thank you, sir. One more question. What will be the tax base for investment property claimed under income from house property as per tax law?
As per tax law, see, this is a particular topic is on accounting standard, Ind AS 12. So I'm not touching upon the provisions of tax law and on that.
Right.
Right.
One more is, if land is revalued and not meant for sale, then what will be the treatment?
Right. So if the land is for revalue and is meant for sale, now question which you have to ask yourself is that when the land is sold in the future, am I required to pay tax as per the capital gain, or I have to pay tax as per my business profit? So if I have to pay tax as per capital gain, in that case, the tax rate, whatever tax rate is applicable, that tax rate I have to use. However, as per Income Tax Act, if that particular sale is being treated as a business sale and business profit is there, and I have to pay tax as per the business profit, so that tax rate. So ultimately, what we are looking at the applicable tax rate when that particular asset is sold. Whatever tax rate is applicable at that time, that tax rate you need to consider for the purpose of computation of deferred tax.
Right, sir. If the company has a huge accumulated losses, then in such cases, it should the DTA created in earlier year should be reversed.
Yes, this point was partly covered during my earlier question answer session, because I said that you need to look at your closing accrued losses. Now, for example, you create a deferred tax assets on opening, assuming that it is probable. But now in the closing, when you're creating deferred tax asset, you assume that now the loss is very huge. It's accumulated very high, and the probability which was there earlier is now not there. So in that case, their DTA will be reversed during the current period from the opening. So how would it be done? You are going to compute a deferred tax asset, what should be closing DTA as on the reporting date. And then the difference between these two is nothing but the reversal from the opening, because the probability criteria of reporting date is not being self-fulfilled.
So, thank you. Some more question. Sir, what if two entities are considered in single operating segment? Will it be set off?
The set of criteria says that there are two conditions. One is legal right to offset. Second is entity intent to offset. Now, you would ask question to yourself, do you have legal right to offset? As you mentioned that there are two segments of one company. And as per the Indian income tax law is concerned, the income tax return is being filed at the entity level, not at the segment level. So when you ask question to yourself that whether you have legal right to offset between two segments, answer is yes, because the income tax return is being filed at the entity level. So whatever is being done at the income company level, that has to be considered as ITR is filed at that level, and accordingly you can offset.
Thank you, sir. So deferred tax on loss for the year and earlier years, if not considered in earlier year deferred tax working.
Yes, so I think maybe there are a lot of questions on laws, which I understand that it is practical situations and which is being like maybe everybody is facing this issue. So the most important thing and most advantageous beneficial for all of us for here is that it is a balance sheet approach. So something is wrongly done, not done, something is not done properly, or something was tax rate is changed. So we don't have to worry much. What you have to do is that step one, look at your closing balance sheet. On balance sheet date, whatever accumulated losses, on that, what should be your DTA? That DTA should be there, and then you minus the opening, and then it is the tax income or expenditure of the current period. So look at your closing, and that closing should be in your balance sheet DTA, and the rest will be in your P&L account.
Right, sir. Two more queries, sir. In the example, 80,000 was relating to December 2018. Why is it then adjusted from 1,50,000 profit for December 2019?
Right, in that example, basically what is happened, I will also touch upon a few concepts of that particular thing, because at the time also there are few persons had asked query about this concept. See what happens that when I consolidate my subsidiary associate joint ventures, at that time I am also accounting the profit in my books of accounts. When that particular subsidiary or associate joint venture, they will distribute the profit to me. In that case, dividend will accrue to me in the future. So when that dividend will accrue in the future, I may have to pay tax on that. Today, 80,000 rupees is not being declared. I'm not exactly sure 80,000 rupees or 70,000 rupees, but the dividend which is being declared today is already shown as income on which the tax is already included in my financial statements. But the income or dividend which is not declared, which is being paid in the future, on which a tax will be applicable in the future, on that we need to create deferred tax, because that amount when in the future will be declared, it will be payable by me. So it is a tax which is deferred to the future till the time of declaration dividend. Hence, we have to consider that deferred tax for the purpose of consolidation of financial statements.
Right, sir. Some more queries. Deferred tax on provision for employees' benefit and provision for debts on receivables. Please explain the concept.
Yeah, see, basically, I think whether it's a provision for employee benefits or whether it's provision for bad debt, ultimately, you need to look at the tax base and you have to compare with the carrying amount. So, is it a bad debt or is it employee? So, whether there's a temporary difference or not, I think that is the question which we need to look at. That if my tax base and carrying amount is different, then on temporary difference, basically I need to create deferred tax. Now going to further on that, so provision for employee benefit, when you take the example, so if my tax base is different, my tax base is same and carrying amount is same, then there is no temporary differences. However, if some amount is payable or some amount is deductible the income tax in the future, which I have taken earlier, then obviously my tax base will be different. So in that case, temporary differences should be created. Same way for bad debt. So ultimately, what is happening is that the amount, whether the amount is deductible or not, amount is taxable or not, as per tax jurisdictions and as per the P&L, if there is a difference in these two aspects, then there will be a temporary difference, unless until it is kind of a permanent difference.
Right, sir. If during the year there is a profit, but in first quarter there is a loss, is deferred tax has to be created in quarter?
Right. So for during the year there's profit, but in the first quarter there is a loss. Okay. See, basically it is on reporting base. As I again come to the one very important thing, that it is a balance sheet approach. You are finalizing a quarter to quarter. So let us take the in first quarter Q1 2021. When I'm finalizing my limited review on 30th June 2020, there is basically a profit. So I will not create difference on that. In Q2, again there is accumulated losses. Or in again, what you happen in quarter wise, you are not going to look at only the quarter, because taxation is not quarter wise. Taxation is also looking into the whole year situations. In Q1, you're not sure of basically whether in the Q2, Q3 there will be a profit or loss. So on Q1, when you do estimation of the full year, and you have estimated that what will be my tax impact on that, and then you have done it. In Q2, Q3, Q4, or all quarters, all reporting, you will do estimation for the full year. Why full year? Because for the purpose of income tax, you need to look at the estimation of for the full year, and then you to provide based on the taxation in your current quarter. So accordingly, every quarterly, you have to create a taxation based on that quarterly impact. And at the year end, again, you to apply the deferred tax, you to apply 31st March 2021, whatever balances are there. On that differences, whatever is created, and then whatever quarter-wise impact you have done it, you minus that. So Q1, Q2, Q3, all three you can minus, and you can give residual impact in Q4.
Right, sir. Last question from YouTube. That is, what shall be the accounting entry in case of recognition of deferred tax in case of compound financial instruments?
Yes. So as I discussed that basically compound financial instrument under Ind AS 109, it says that you need to classify into two parts. One is liability and second is equity. 100 rupees is my compound financial instrument amount. 30 rupees is my equity. 70 rupees is my liability. Now, 30 rupees is basically on what it will go to my equity component. So what will happen that I need to take deferred tax on 30 is created. So equity account debit. Why equity account debits? That is the component which will go along with the component. Component goes to where? In equity. So in other equity, there is a component of compound financial instrument or equity of the compound financial instrument is component. So other equity account debit, that means that component account debit and credit to deferred as liability. That is the general entry which you have to pass for that.
Thank you. Thank you, sir. Thank you so much. We will reassemble around 12:55. That is after 5 minutes comfort break. Thank you, sir.
Okay.
Radhakrishnan ji, good afternoon.
Good afternoon, sir. Good afternoon,
Yeah,
sir. How are you?
start. Mansukh bhai, start.
Yes, yes, sir. Welcome back, friends, for the second session of Ind AS 36 Empowerment of Assets. And sir, Chintan bhai, it's over to you.
Yes, thank you so much, Manzuk bhai. It is really, I think, 5 minutes break was required.
Yes.
And you all been, yes, it also gives a time for all of you to have a little bit chat. So it also create a bonding, because sometimes what happens that technical session is there, but what we are missing in this life is that having interaction.
Yes.
And everybody is being working silos. Everybody is at home, office, but unless until we have to have interactions, we don't enjoy it. So this is something
Absolutely,
very, very important thing.
Yes.
Now let us move to our Ind AS 36. I will share my presentation on 36. Okay. So the impairment of assets, it's a standard. When I talk about this standard, first very important thing is that the difference is not very big as far as this standard is concerned compared to AS. Under AS 28, accounting standard 28 is under Indian GAAP talks about the impairment of assets. And Ind AS 36 is also an impairment of assets. The both are little bit same. There is not a difference on these both standards. But let us look at this particular standard to understand that what is the principle underlying that, how to do computation on, and which are the issues that can come when you do impairment of assets, when the impairment is required. So these are the few things which are being there. I think on the front page, first slide of impairment of assets, I have kept on left hand side, there is a couple is there, and there is a cross between both the things. So in one of my session, participants said, "Sir, this is not impairment of asset; it is impairment of liability." So I think with this lighter note, which I'm trying to say is that yes, asset or liability is different. However, let us look at the how and where and what to do impairment of assets and when impairment is required. So in each standard, in my view, if we really want to learn the standard, the first and foremost is to look at the objective principles underlying the standard. Reason for issuing the standard is very important. So the objective for the standard is to ensure that the assets are carried at no more than their recoverable amount, and to define how recoverable amount is calculated. So primary talks about the situation where you need to ensure that the when I have the value in my balance sheet of assets, the value of the assets shall be at least equal to recoverable amount. And wherever if I feel I have indicators that the amount in my balance sheet of assets is not at least recoverable amount, then this standard says you break down the amount to the recoverable. Because the age-old principle is what it is at conservative approach. So I shall not have the amount in my balance sheet as an asset which is higher than its worth. So if it is higher because of the ABC situations, then it is the principle which is underlying the standard which says that you need to bring down the value to the recoverable amount where this is a situation. So to ensure that the assets are carried at no more than their recoverable amount, and to define how recoverable amount is to be computed. So the standard talks about two things. One, just to ensure the carrying amount is at least equal to recovery amount, and second is that how you can compute the recovery amount. The principles, the methodology is being provided under this standard. The scope of standard Ind AS 36, it applies to all assets except Ind AS to inventory. Why? Under inventory standard, it says that inventory shall be measured at cost or net realizable value, whichever is lower. So there is already a inbuilt impairment provisions under standard itself, which says the cost or NRV which is lower. So this standard does not apply to inventory Ind AS 2. Contract assets that arising from the contract with customers. Ind AS 115 also have inbuilt provision that the contract assets shall not be more than the recoverable amount. So these kind of contract assets are excluded from the scope. Ind AS 12 income taxes, as we just discussed on deferred tax assets, that deferred tax assets recoverable amount and probable is a criteria, and it provides a detailed guidance that how to and how much to recognize for deferred tax assets. So that particular standards we wanted to refer for impairment for DTA. 700 Ind AS 19, if any asset is created, there is a requirement to do actual evaluations, and there is requirement to have a look at into the provisions and standards Ind AS 19. For 109 financial instruments, there is separate provisions which talks about impairment of financial assets, which requires you to recognize impairment loss on financial assets. So that is 109 talks about that. For biological assets that are measured at fair value less cost to sales, you can refer to Ind AS 41. It has already a provision which talks about measurement at fair value less cost to sales. Ind AS 104 insurance contract, which has inbuilt provisions to ensure that the assets are not more than the recoverable amount. And lastly, but not least, is on Ind AS 105, that it is a non-current asset held for sale and discontinued operations. So for non-current asset held for sale, the 105 talks about measurement at lower of carrying amount and fair value less cost to sales. So in all these standards which are excluded from the scope, in all these standards, there's inbuilt provisions to ensure that the amount of the assets are not more than recoverable amount, and they provide a detailed guidance, detailed methodology, detailed principles to talk about the impairment. That's the reason why these are scope out from Ind AS 36, and for rest all other assets we need to apply Ind AS 36. There is always one question about the difference between impairment and depreciations. And this slide I added after my interaction with in one of the session which in IFRS certification course, where the participant asked me question that what is the difference between impairment and depreciation? Yes, obviously when you look at the primary, it says depreciation is on the use, basically on remaining useful life, the amount is depreciated, amortized, and as the asset is being used, there is charge for use. And as far as impairment is concerned, impairment is with respect to the sudden loss. That is what is done. So impairment is diminution in the value of asset otherwise than depreciation. And depreciation, the objective is to charge the cost of assets over its useful economic life. Under depreciation, the matching concept is being applied. Under impairment, the objective is to bring down the carrying amount to its recoverable amount. It is more of like prudence concept. However, when you look at depreciation, it is more relevant with respect to the use of asset. The charge to profit and loss over the use of asset is the depreciation. In the impairment, it is more like sudden change and sudden loss of value, and that is being recorded by way of the impairment charge under profit and loss. Now, impairment, when you talk about how and where there is impairment, the impairment is there. For that, we need to compare carrying amount with the recoverable amount. When we talk about Ind AS 12 income taxes, We're comparing carrying amount with tax base, and then on temporal differences, we talk about the deferred tax assets, deferred liability. As we look at the objective of the standard Ind AS 36, the objective is that to ensure that the assets are not being carried at the amount higher than recoverable amount. That is the main objective. So that is the reason why we need to compare carrying amount with recoverable amount. And if the carrying amount is higher than recoverable amount, then the difference is called impairment loss. So carrying amount is minus recoverable amount is my impairment loss. And as we discussed in the objective, that how to measure recoverable amount, and for that recoverable amount is being taken as higher of net selling price, or it is called as fair value less cost to sell, or value in use. So these are the two main measurement approaches which are there for the recoverable amount. Recoverable amount is what? Higher of net selling price or value in use. So if value in use is higher than net selling price, you may not compute net selling price and you can go at value in use. If the net selling price is already higher than value in use, you may not compute value in use in detail, and you can consider as a net selling price as a base. So these both are the very important thing for the purpose of arriving at recoverable amount. Let us look at the very important definitions, which are very basic definitions, but is required for understanding and to ensure that we are on the same page. Carrying amount is the amount at which an asset is recognized in the statement of financial position after deducting accumulated depreciation and accumulated impairment losses. Fair value is a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. There is a new standard Ind AS 115 of fair value, 113 fair value measurement, which talks about the detail on how to measure fair value. Value in use is the discounted present value of estimated future cash flows expected to arise from its disposal at the end of its useful life. So what is here is that value in use is basically by use. If you use the asset, what is the value you perceive to be received over the period? The present value of that value is called value in use. And when you talk about the second approach of net selling price, where we are talking about if I sell, then how much amount I will fetch, how much amount I will receive it. So where we need to also reduce the cost of disposal. So fair value less cost of disposal and value in use, they both need to be computed, and higher of these two is my recoverable amount, and that recoverable amount will compare the carrying amount, and if the carrying amount is higher than recoverable amount, then the differential amount is called impairment loss. Let us look at the frequency of impairment testing. So at what period I have to do impairment testing? When I have to do impairment testing? First, it says that you have to assess at the end of each reporting period whether there is any indication of impairment. So if I have a quarterly reporting, if I have a half-yearly reporting, if I have monthly reporting, if I have annual reporting, at the end of each reporting period, I need to assess about impairment indicators. If there are impairment indicators are there, then I may have to do impairment testing. In three situations, in three cases, irrespective of the indicators of impairment, at least annual impairment testing is mandatory. So even though there is no indicators, the company's business is doing fantastically well, all profit is increasing, business is very good, There is no point that there is going to be basically impairment, but still in these three cases, impairment testing annual is mandatory. First, intangible assets with indefinite useful life. You must have gone through the standard of intangible assets where it mentioned that the useful life of intangible assets can be finite or it can be indefinite. And where the intangible assets useful life is indefinite, in that case, impairment testing annually is required. Second, intangible assets that are not available for use. I have taken purchase intangible assets, but they are not still available for use, are not amortized. So when there is no amortization charge is there, standard says that you have to have impairment testing. Third, goodwill that is acquired in business combination. So whether the goodwill is there, as goodwill is not being amortized, impairment testing is required. See, if you look at the logic of these three things, that where there's no amortization, where there's no depreciation, in that case, you have to have ensured that the amount of asset is not more than recoverable amount. So that is possible only when you have impairment testing. This impairment testing is called three-stage approach. Stage one is on indicators of impairment. That means wherever you have impairment indicators, as I discussed that there are three situations irrespective of the indicators, impairment testing is required. However, in normal cases, if you have a first, you find that the indicators are there. The business is not doing very good. The possibility of the losses, technological advancements, the company in such a phase that it's possible that it may be possible that few units may not be workable. So there are indicators of impairment. The indicators of impairment can be internal or it can be external indicators. So when there are indicators of impairment, stage one. Second stage is that determine recoverable amount. So indicators of impairment are there, and then you have to do impairment testing. So when you have to do impairment testing, the step one is that recoverable amount you have to decide. And that recoverable amount you have to compare with the carrying amount. But recoverable amount, how to determine recoverable amount? You have to either do value in use or fair value cost to sales or both. And higher of these two is your recoverable amount. Stage 3 is if the carrying amount is more than recoverable amount, the difference between these two is my impairment loss. So you reduce, pull down the carrying amount to recoverable amount. Let us look at indicators of impairment. As I discussed that except the three situations which I mentioned specifically, where at least annual impairment testing is required. However, in all other cases, impairment is required to be done where there are indicators are there. Indicators can be external or it can be internal. External indicators, example is that where the market value declines rapidly. There may be some reason behind that. There are negative changes in technologies, market economy laws which is affecting the business, increase in market interest rate drastically, company stock price is below book value, internal sources, obsolescence or physical damage, asset is a part of a restructuring or held for disposal, worse economics performance than expected. See, again, there is possibility that one of the indicators may be there. It doesn't mean that you want to do impairment testing. These all are indicators, and based on the all indicators, you have to come to conclusion to whether impairment testing is required or not required. One of the few small indicators may not mean that there is a need to do testing, but yes, it gives you a basis to consider that is there a need or not. So external indicators are with respect to the economy, environment, legal, business, which is technology, and internal indicators are with respect to the assets or the position within the company. That these are the indicators which will provide you the guidance about whether implementation is required or not required. Let us look at one case study to understand this point. Entity A, located at Singur, is a major supplier of auto manufacturers X Limited, and its year end is 31st March. In April 20, X Limited announces the closure of its plant at Singur in 18 months' time. As a result of this, Entity A's plant and machinery dedicated to supplying X Limited will have a remaining useful life of only 18 months. In addition, the company's factory premises may be impaired as they have no alternative use. Determine the impact of A's financials for the year ended 31st March 2020. See here what happens that this is a subsequent event because my year ended was March. However, this happens in April. The subsequent events, we need to refer the standard Ind AS 10, which says that it can be adjusting or non-adjusting event. If the event that happens subsequently where the condition is not existing as a reporting date, then they are called unadjusting events. Only one exception to that is that in case of going concern, assumption is not there. In this case, looking into the situations, the going concern is vitiated and possibly the company may not be going concern. So in that case, even from March 20, the impairment testing is required to be done. And if there is a huge impact on the financials of impairment loss, that need to be computed and provided for. Let us have a very basic understanding of how this formula works. As we discussed that first there will be a carrying amount. Carrying amount is nothing but a cost less accumulated depreciation and impairment. The carrying amount comes to 600, 1000 minus 400, 600. We need to look at recurrent amount. For recurrent amount, it is a higher of fair value cost to sale and value to use. If the higher of these two comes to 900 rupees, recurrent amount is higher, carrying amount is lower. There is no impairment loss. However, in the second situation where the carrying amount is 600 and recurrent amount is lower, 400, then the impairment loss of 200 will be there. Now let us understand how to measure and arrive at the recoverable amount. First point of recoverable amount is fair value less cost to sell or determining net selling price. As the particular definition or meaning itself provides the fair value less cost to sale. So you need to determine the fair value, and from the fair value of the assets, any cost of disposals which is going to be there if I want to sell it, that need to be reduced to arrive at the recoverable amount. So as far as recoverable is what, how much amount I can fetch. So amount which is required to be incurred for selling and the selling cost, it is to be reduced from fair value, then only I know what amount I can recover. So first is fair value, second is cost of disposal. Fair value, how to determine selling price of fair value? So if there is some binding sales agreement that is based source of evidences, then you can refer to the price in the binding sales agreement, and that is your fair value. If it is not that, you can look at the current or most recent market price. If it is not that, you can look at the based on recent transaction of similar asset within same industry. So these are like hierarchy of determining fair value. It is originally from Ind AS 113 fair value. So first binding sales agreement, second not available, go to the current or most recent market price. If it is not available, go to the recent transaction of similar asset within same industry. Then comes the cost of disposal. The cost of disposal, as I mentioned, that the amount, the objective is to identify the amount which is recoverable. So that means you need to also reduce the amount of cost which you have to incur for that to recover the amount. So direct incremental cost to bring the asset into condition for sale, legal cost, stamp duty, cost of removing asset, these all are directly relevant to this particular sale. These need to be reduced from my fair value to understand and to determine the amount of recoverable cost for fair value cost to sale. Now let us understand how to determine fair recoverable amount for value in use. Value in use, it means that if I continue to use the assets, what is the value being fetched by the company if they use the particular assets? That has been determined by value in use. So what is done here is that in generally, practically I've seen in most of the cases, the value in use is determined by way of using the projected cash flows. So wherein the present value of the estimated future cash flows that are expected to arise from continuing use of the asset and disposal at the end of its useful life, they both are considered. So what is done first? You need to have the projection of the future cash flows. And when you do projection of the future cash flows, it's not only the use, but also in case you sell the asset, how much amount you can fetch, that both need to be considered. So cash flow of that estimation, you have to do it for next future years. Then you need to do discounting, because the objective is to determine recoverable amount of today, because we are comparing the recoverable amount with the carrying amount as of the reporting date. So if the amount is to be receivable after 10 years, the worth of today is less. So then comes applying a discount rate to the projected cash flows, and then do get the present value. And that present value is the recovery amount, and that recovery amount you have to compare with the carrying amount. And in that case, if there is a loss, it's the impairment loss. For DCF calculations, the most important things are two. One is the cash flows, and second is discounted. Now, here let us look at the cash generating unit, CGU. How this concept of CGU come into picture? If any asset is impaired, or if there are indicators of any asset being impaired, standard says that you have to do impairment testing at the asset level, and you determine the value in use and the fair value cost to sale of that asset, and then you impair it. However, if that asset is not being functioning independently, but that asset is being functioning, or the value of that asset is coming out from the other similar operating assets which together function for deriving the value, then it says that impairment testing should be done at the CGU level. Because if I just do the recovery amount at the asset level, that may not be true, because the asset is not generating value by itself. It is depending upon a lot of other assets and liabilities in general, and at the group level, we need to look at the recovery amount. So cash generating unit is defined as the smallest identifiable group of assets that generate cash inflows from continuing use, that are largely independent of the cash inflows from other assets or group of assets. So again, the object is the smallest identifiable. So as far as the asset is itself is generating, it is asset itself. If the asset is not generating, but then what is the next level at which they are able to generate independent cash flow? That next level is the smallest identifiable group of assets that generate cash inflow from continuing use, that are largely independent of the cash inflow from other assets or group of assets. So your impairment testing shall be done at the CGU level for determination of value in use and recoverable amount. Second point which come to mind is on allocating goodwill to CGU. If a company has acquired another company or a division of another company, then there may be a goodwill. Now, when the goodwill is arising in the books of accounts of the acquired company, then this goodwill is what? Goodwill is the amount which is extra paid. Now, extra paid is what? Because the company expect to get the benefit from the synergies of combinations. If that is the situation, then for the purpose of doing impairment testing, if you keep the goodwill out and then you do testing at the other level, it is not correct. Because ultimately goodwill need to be allocated to the particular operation, the particular CGU, which gets the benefit. Otherwise, goodwill won't be impaired. That the objective of doing impairment testing of goodwill is not met if the goodwill is not being allocated to the particular CGU at which it belongs. So goodwill shall be allocated to the CGU that gets the benefit of synergies of combinations, and then impairment testing shall be done. So goodwill is allocated to CGU that is expected to benefit from the synergies of combination. Each unit or group of units to which goodwill is allocated shall represent lowest level within the entity at which goodwill is monitored for internal management purpose, and it shall not be larger than the operating segment as determined under Ind AS 108. So this is a way CGU goodwill shall be allocated to CGU. Let's look at one example to understand that what is the CGU level. Jet Airways providing flight services under contract with airport authority that requires a minimum service on each of the 5 separate routes. Assets devoted to each route and the cash flow from each route can be identified separately. One of the routes operate at significant loss. Identify CGU for impairment testing. Now what happens that for this kind of companies, they may have to fly from lost routes as a condition for them to get the profitable routes. So like Mumbai, Delhi is a profitable route. However, moving from some small city to the Mumbai may not be profitable, but however that is required because the government wants to have connectivity across the country. So the company is operating on that loss route because they feel it's condition which is required for them to operate on the profitable routes. So in that case, we cannot have that CGU at each route wise because they both are in together to be seen for the purpose of impairment testing, and then the whole company may be a CGU for the purpose of the impairment testing. Because the entity does not have option to curtail any one of the route, the CGO of each route is the company as a whole. Electro Limited is a vertically integrated electricity utility. It has 3 distinguishable business: generation, distribution, and supply. There are active markets for the output of generation and distribution businesses. The generation business sells power to the distribution business, which distributes electricity to the supply business. Internal transfer pricing approximates market price. Identify CGU for impairment testing. Now, company has 3 separate verticals, and at the end, the company sells to third party only for the last vertical. So, generation, distribution, and supply 3 verticals. Now, all these verticals have a separate asset, separate operations, and that can be possible to have internal transfer pricing. So each separate vertical is a separate CGU for the purpose of consideration of impairment testing. Goodwill. I think as we discussed that allocating goodwill to CGU is very critical. And when we talk about this impairment testing, in 3 cases, annual impairment testing is compulsory required, which includes goodwill. So for doing goodwill, you need to allocate because goodwill cannot be tested separately. It is based on the particular operations, it's based on the particular business. So first step is to allocate goodwill to CGU. Now, second comes to picture is that in case if there's a disposal, I have goodwill of 100 rupees, which I allocated to the CGU A. Now the company wanted to dispose of the CGU A. So in that case, that goodwill will also be disposed of, goodwill will also be removed as the CGU A is disposed. Why? Because the goodwill has a value with respect to only the CGU for which it is holding and for which the value has been created. So once the CGU A has been sold, obviously the goodwill which is corresponding to the CGU A will also be disposed of, will also be considered as a disposed of as part of the operation which is being discontinued. Reorganization of reporting structures. The company CGU A, CGU B, and the goodwill was allocated to CGU A first. Now company has classified certain part from CGU A to CGU C. Now in that case also the goodwill need to be again reallocated from CGU A to CGU C. See, objective is what? Objective is that the goodwill itself has no value. Goodwill is for a particular operations, and the operations of CGU to which it pertains, the goodwill shall be along with that. So when you have a carrying amount, the carrying amount is what? Carrying amount is not only the carrying amount with that particular CGU, carrying amount shall always include the amount of goodwill to which that particular CGU pertains. Testing CGU with goodwill for impairment, as we discussed, that ultimately the objective is that when you do impairment testing, you need to first allocate goodwill to CGU. Second, your carrying amount is a CGU carrying amount plus goodwill which is allocated, and then they both are being compared with the recurring amount for the purpose of basically testing of this goodwill. Next point is on corporate assets. The question which will come here is that how to allocate corporate assets. We discussed about goodwill, but what about corporate assets? Corporate assets are like head office building, which is common to across all CGUs. So the standard says that in case if you are able to allocate on reasonable and consistent basis the corporate assets which are common to CGUs, you please allocate it. However, in case if you are unable to allocate that particular thing, then in that case you have to do CGU goodwill impairment testing at the CGU level and also at the company level for the purpose of doing impairment testing. Timing of impairment test. Now, as we discussed, the impairment testing should be done at each reporting date annually, at least for the purpose of 3 things. However, for others, wherever there is impairment indicators are there, at every indicators you will do impairment testing. So the question may come that we talk about that we will do annual impairment testing. So every year I have to do fresh calculations, every year I have to do the same thing, or can I use the last year calculations? The standard says that yes, you can use the latest calculations for the purpose of your impairment testing. However, please ensure that basically there is not a huge change, there is not major change from the business from last year to current year. Second thing is that last time when you do calculations, the recoverable amount was very high compared to carrying amount. And third thing is that even if you do complete fresh calculations, it is 100% chances are there where you are going to conclude that the recoverable amount is very high. So if these 3 conditions are fulfilled, in that case, you can use last year's calculation as a base, and then you can do a comparison so that very easily the annual impairment testing can be done. Let's look at a case where a CGU was reviewed for impairment at 31st March 2019. and recoverable amount estimated at rupees 3 million. Recoverable amount was based on FVLCTS, that is fair value as cost to sale. Goodwill of 6 lakhs has previously been allocated to CGU and is not impaired at 30th March 19. In 2020, part of CGU is disposed of for 22 million net of disposal cost. How it will affect goodwill? I think the principally what we discussed that the goodwill is allocated, and wherever some part is disposed of, that particular part of goodwill also will be go off the balance sheet. You can't keep the goodwill throughout for lifetime, as the part to which the goodwill belongs, if that is disposed of, the particular part or portion will also be moved out of the balance sheet. Now let us look at the process of impairment loss. First is that allocate impairment loss to assets in the following order. 1. Goodwill is allocated to the CGU. So first step is allocate goodwill to CGU. Second, basically, okay, so we are talking about goodwill. First allocate goodwill to CGU. Then you do impairment testing. Carrying amount is including goodwill and carrying amount of CGU. Recovery amount is compared with the carrying amount. Difference between recovery amount and carrying amount is my impairment loss. Now, once impairment loss is there, how to and to which asset I have to reduce, that is being measured here. So it's like order of recognition of impairment loss. In the order of recognition of impairment loss, first is goodwill. So whatever amount of goodwill which we consider as a part of my carrying amount, that goodwill is to be reduced. Second, after reducing goodwill, whatever impairment loss remain, that impairment loss is to be reduced by in all the assets on pro rata basis. So for example, I have 1,000 rupees of impairment loss and goodwill is 600 rupees. So first my goodwill base becomes 0. So goodwill is impaired. Then remains 400 rupees impairment loss. That 400 rupees impairment loss, that will result into reduction of all other assets which are in CGU. On pro rata basis, I have to reduce pro rata of the carrying amount, I have to reduce the impairment loss. However, second point important is that when you reduce the carrying amount of the asset of pro rata basis, to ensure that do not reduce the carrying amount of any asset below the highest. So when I reduce the pro rata, it doesn't mean that I make it 0. Do not reduce below the highest of the asset's net selling price or value in use and 0. So higher of these three, say I should reduce below that. So ultimate objective is to identify which are the culprit assets for which the value is lower, and you reduce that assets. And for that, there is this kind of proposition is mentioned that you cannot reduce below as the highest of value in use, net selling price, and 0. Example of allocation of impairment loss, there is indication that the group of CGUs may be impaired. There is impairment loss and allocate impairment loss based on the details of impairment testing as provided below. Goodwill's carrying amount was 600. CGU A 1000, CGU B 180, CGU C 500. Total carrying amount was 2280. Recovery amount was 1400. So 1400 is my recovery amount. So my impairment loss is how much? 880. 880 is the difference between carrying amount and recovery amount. So 880 is my impairment loss. First, it will be allocated to the goodwill. So 880 impairment loss, 600 first reduction of goodwill. Then there is a 280 that will be allocated in such a fashion that I cannot reduce to the highest of fair value cost to sell, value in use, and the 0. Then 80 will be allocated to CGU B or asset B, and to CGU C 200. So this is the way the impairment loss will be allocated. Now let us discuss about the reversal of impairment loss. Impairment loss, basically, when you give impairment loss, it is based on indicators. It can be internal indicators or external indicators. Then you done impairment testing. Then you arrive at the impairment loss. Now, future, what happens that there are indicators where there's a reversal of negative things. There are positives that are there. So internal and external indicators for reversal, if change in the estimates used to determine recoverable amount, and on reversal of impairment loss. So, for example, there is an impairment loss was 1,000 rupees was recognized, and then there are indicators where there's a reversal is required. If there's a change in estimate, I use the estimation of cash flow is changed. These are estimate change. Then there's a reversal in impairment loss. So how can I re-establish my carrying amount? So when I reverse impairment loss, I will increase carrying amount, because when I charge impairment loss, at that time my carrying amount was reduced. So when I reverse my impairment loss, I have to also reverse my or increase my carrying amount. But when I increase my carrying amount, I have to ensure that had I have not done impairment loss, then whatever may be the carrying amount, that carrying amount I should not reverse or increase carrying amount more than that. For example, there is a fixed assets. Fixed asset is required to be depreciated. Now I have charged impairment loss to fixed assets. So after charging impairment loss, the depreciation is reduced because the carrying amount is reduced. So had I not done impairment loss, what will be carrying amount today? So when I reverse my impairment loss, I should not increase the carrying amount higher than that. At least depreciation amount of impairment shall be there. I cannot reverse beyond that. So any reversal of impairment loss will be taken to the P&L account, except in case of the reversion reserve for reversion model, which is already there in OCI. To that extent, I can set up to my reversion reserve. Otherwise, I have to take to my P&L account. And please ensure and bear in mind that reversal of impairment loss for goodwill is prohibited. Why it is prohibited? Because standard says that under Ind AS 38, intangible assets, self-generated goodwill is prohibited. Now, when there's a reversal of impairment loss, and by reversal of impairment loss, when I create goodwill, it is nothing but the self-generated goodwill. And the self-generated goodwill is prohibited. So reversal of impairment loss for goodwill is prohibited under Ind AS. I think this is what we discuss as far as the impairment testing is concerned, and we can take questions answer. Vagila bhai.
Ajay sir.
Yes, please.
Yes,
sir.
sir. Yes, sir. Thank you, sir. Can we take some questions, sir?
Yes, please.
Yeah. What about the loss of profit, nafe mein nuksani, due to time gap between removal of old plant and installation and start of new plants?
Loss of, sorry, can you please again repeat? Let me just look at chat.
Yeah, loss of profit due to time gap between removal of old plant and installation of new plant.
Yeah, see, basically, we are talking about actually impairment testing. So you need to compare the carrying amount with the recovery amount. And for recovery amount, it is higher. Now, short time period is not very critical for impairment testing, as you are aware that for value in use, we're going to consider all future cash flows. So there may be a temporary drop down. However, value in use is we will consider all your future cash flows, and recurrent amount is nothing but a higher of value in use and the fair value cost of sale. So in that case, recurrent amount is bound to be higher, and there is no need to create. There won't be any impairment loss because of the temporary loss period, as you mentioned.
Right, sir. Sir, assets in the nature of administrative purpose does not generate any value. Please explain.
basically we can't say that assets of administration can't generate value. The reason is that we all are aware that there are a lot of back office staff is there. We can't say that accounting, auditing are also the back office thing. So all have basically value for the purpose of business, and these all are providing direct and indirect support for the purpose of the value generation. So
Right.
that is the reason why anything which is not directly relevant to the particular CGU, but it is common, like corporate asset, which I give you example of corporate assets. So in that case, you have to allocate corporate assets to the particular CGU, and then you can do impairment testing.
Right, sir. Sir, for infrastructure company, Mumbai to Goa route, how to work out impairment of part of the routes which is destroyed by rain or otherwise, in addition to substantial loss due to COVID?
If anybody can ask, give me that question answer. Mumbai to Goa route, when you say means what do you mean by that? So you're saying aircraft industry. I think if you can elaborate,
Sir,
anybody can elaborate. Can you allow the question queries to
infrastructure? It's an infrastructure company, and how to work out the impairment of part of the routes which is destroyed by rain or otherwise, in addition to the substantial loss due to COVID.
Destroyed by rain.
Yeah, rain or otherwise, natural calamities.
Okay, fine.
Yeah.
So basically, what I understand that there's an infrastructure as a company is there. The company is having the assets. Assets are capitalized, which is not inventory, which is my property and equipment. And because of the COVID-19 or others, the recoverable amount of that asset is lower than carrying amount. In that case, there has to be a impairment loss. And that you need to, again, so what you do it, you do arrive at the recovered amount. So if you use that particular asset, how much amount you're going to get? So you first look at value in use. If the asset is not usable, then you can look at the sale price. And what is the amount to be realizable if you sell the asset? Higher these two is your recoverable amount. And that recoverable amount, if it's coming lower than carrying amount, the differential is impairment loss which you have to charge.
Right, sir. Thank you. Sir, depreciation on next year after impairment, if reversed of impairment, what will be the treatment for depreciation?
So basically, what will happen that your depreciation will be charged on your revise or net of your carrying amount. For example, today my carrying amount is 100 rupees. Depreciation I have charged 10 rupees. 90 is carrying amount after depreciation.
Think we lost the net.
Is my carrying amount, which is a net of depreciation and impairment loss. So next time depreciation shall be based on 80. Because depreciation is nothing but the useful life, estimated useful life, or it is called expected pattern of consumption of your carrying amount. So the depreciation shall again will be accumulated in accumulated depreciation, and it will be set off against the carrying amount.
Right, sir. Sir, one question related to Ind AS 12, that you replied on current tax remains same in both the cases. That is earlier approach in AS 22 and new approach in Ind AS 12. Whether deferred tax will also remain same under both the cases?
No, sir. See, otherwise there is no point of discussion of this standard. So as your question was earlier on current tax, I mentioned on that current tax remains same. Deferred tax will definitely change. And that is the reason why we discuss in detail about which are the main principles, how it is being changed. So this all we need to really look at. So deferred tax will definitely change because this approach is different. But as far as you are talking about practical impact on deferred tax, it may not be very big because if you look at depreciation in general companies, it may not be very big. However, when we move from AS to Ind AS, there are a lot of Ind AS adjustment you provided. So on all Ind AS adjustments, they are in books of accounts. So carrying amount is increased or decreased by Ind AS adjustments. However, in the tax base, there is no change. So on that, you do create deferred tax. So deferred tax will definitely undergo change under Ind AS.
Right, sir. What is the treatment for discard of any asset having WDV in books with no realizable value?
Discount or discount rate.
Discard. What is the treatment for discard of any asset?
Discard. Okay.
Yeah.
Basically, if the discard is or sale or disposal of asset, then obviously it will go out of your books of accounts and the loss shall be recognized. So discard or disposal is governed under Ind AS 16 for particular assets, and then it will be loss on disposal will be recognized.
Right, sir. Can you please brief on allocation of impairment of loss between highest and lowest value of CGS?
Yeah, so basically, when we take the example of impairment loss allocation, the principle says that step one, we need to allocate impairment loss on goodwill. After we allocate to goodwill, if there are CGU or assets, then we need to allocate to the CGU in such a fashion that ultimately the carrying amount is not reduced below the highest of net selling price, value in use, and zero. Why? Because the objective of impairment loss is to impair or break down the price of the asset which is high. Now, by just doing allocation and pro rata basis, should not happen in such a fashion that some asset where it is recoverable is already good, but still I will bring down because of the mathematical calculations. So at CGU level and at each asset level, we will ensure that the value or carrying out the asset is not reduced below the recoverable amount.
Thank you, sir. Sir, can you please explain reversal of impairment again with the number? How much to be credited to profit and loss?
Right. Let us take an example that the company has done impairment loss of 1,000 rupees, and the general entry which was passed was impairment loss, profit loss account, and credited to the carrying amount of asset which has been impaired. Now the future, basically 200 rupees is reversed because of the external because of the change in estimation which are used there. So then in that case, 200 will be the carrying out debit and credit to my P&L account as a part of impairment loss reversal. So the reversal of the entry which is passed the first time, that is what we do for reversal of impairment loss.
Right, sir. Sir, due to COVID-19, plant was shut in the month of March 20. Whether standard prescribed to account for impairment of loss, how the loss of production due to COVID-19 be accounted under this Ind AS?
Yeah, I think I understand that there may be a lot of issues and questions on COVID-19. And being a regional council member of WSF ICI, I would like to draw attention to everyone that there is a separate COVID-19 resource page on ICI homepage. On that COVID-19 resource page, you will find a lot of guidance which is provided by ICI for these kind of situations where going concern, subsequent events, then impairment testing, inventory verifications. There is a lot of guidance available. You can refer to that. So there is no separate guidelines available under Ind AS standard for COVID-19. We need to apply the principles which are mentioned under standards. However, we need to be more cautious as far as impairment testing is concerned because of the nature of industry. The nature of industry is such where there are chances of impairment due to COVID-19, then yes, we need to follow the procedures for impairment testing, which is specified under Ind AS 36.
Thank you, sir. The same old question, that is Bombay-Goa route. In case of Bombay-Goa route, question, the company has got the right to collect toll taxes. So what will be the treatment as the income earning in Goa route is washed away?
Okay, so I think your question is primarily with respect to Ind AS 115 appendix, which talks about service concession arrangement. So we need to look at the financial assets and receivable, which is created under Ind AS 115, and then you need to do impairment testing for the amount to be receivable. As you talk about Bombay-Goa route, and where the company got right to collect, so you apply Ind AS 115. And right to collect is basically intangible assets. So you have created intangible assets under Ind AS 115. So, so if that intangible asset you feel that the amount is not being impaired, amount is being impaired because the Bombay Goa route is being completely changed. So obviously you to impair, and you have to bring down that intangible asset in such a fashion that the amount which is measured or amount which is appearing in the financial statement is not more than recoverable amount.
Thank you. Thank you so much, sir, for this excellent and wonderful session, sir. After listening today's session, मैं इतना कह सकता हूँ कि किस कदर शुक्रिया अदा करूँ आपका, किस कदर शुक्रिया अदा करूँ आपका, उसके अल्फाज नहीं मिलते. इंडेस इतने सिंप्लीफाइड ना होते जो आप जैसे स्पीकर ना मिलते.
वाह वाह, क्या बात है.
So wonderfully done, sir. On behalf of all the association, that is Tax Practitioner Association Thane, Josh Professional Foundation, Tax Friends Association Mumbai, भिवंडी Tax Practitioner Association भिवंडी तर्फे आपला मी खूप खूप आभार व्यक्त करतोय सर. जीएसटी बार एसोसिएशन वाराणसी, इनकम टैक्स बार एसोसिएशन प्रयागराज की ओर से आपका बहुत बहुत शुक्रिया. एसोसिएशन ऑफ टैक्स प्रोफेशनल वेलोर कारपाका मीका नानरी, थैंक यू सर. लीगल रिलीफ सोसाइटी कोलकाता पक्षे धन्यवाद चिंतन भाई, थैंक यू. Last but not the least, thank you all delegates for being with us for this wonderful webinar. Thank you very much. Thank you one and all. It's over to Vijay bhai for future announcement. Thank you, sir.
Unmute. Unmute.
Vijay bhai, unmute please.
Thank you, Mansukh Bhai, for conducting the deliberations beautifully today. Thanks, Chintan Bhai, for the deliberations and enlightening the participants. Looking forward to more from you. And thank you, friends, for joining. The next session will be on next Saturday, 11 to 2, Ind AS 40 and 41 by CA Rajesh Modi. Looking forward to see you then. Till then, bye-bye.